There has been a noticeable rise in conversation recently about the silver market, especially around the sharp price movements that many viewers have been watching closely. Some discussions suggest that large financial players may have adjusted their positions during the decline, while others question whether the quoted market price is reflecting the full picture. In this video, the goal is to calmly and clearly explore what is actually supported by available information and what may simply be speculation, so that you can better understand the situation without unnecessary confusion or exaggeration. Before going further, it helps to stay grounded in a simple idea. Financial markets often move quickly, and when they do, narratives tend to move even faster. This can create a gap between what is known, what is likely, and what is assumed. The purpose here is not to take extreme positions, but to carefully separate signals from noise. In recent weeks, silver experienced a noticeable drop in price. For many participants, especially newer investors, this kind of movement can feel unsettling. It is natural to interpret a falling price as a sign of weakening demand or a failing market. However, markets are not always that straightforward. Sometimes price movements are influenced by structural or mechanical factors that do not directly reflect long-term demand or supply conditions. One important factor often discussed in such situations is the role of leveraged trading. When markets become volatile, leveraged positions can be forced to adjust quickly. This can lead to rapid selling, not necessarily because participants have changed their long-term views, but because they are required to meet margin requirements or reduce risk exposure. When this kind of activity happens across many participants at once, it can amplify price movements beyond what fundamentals alone would suggest. At the same time, it is important to look beyond price and consider other indicators. Physical demand, inventory levels, and international trade flows can provide additional context. For example, reports have indicated that certain regions, including large industrial economies, have continued to import significant amounts of silver. This does not automatically mean that demand is surging uncontrollably, but it does suggest that the underlying use of silver has not simply disappeared. Silver occupies a unique position among commodities because it serves both industrial and investment purposes. It is used in electronics, solar technology, and various manufacturing processes, while also being viewed by some as a store of value. Because of this dual role, its price can be influenced by a wide range of factors, sometimes pulling in different directions at the same time. When industrial demand remains steady while financial markets experience stress, it can create situations where price behavior appears inconsistent. This does not necessarily indicate manipulation or failure of the system. Instead, it often reflects the complexity of a market responding to multiple forces simultaneously. Another point that has been widely discussed is the level of available inventory in major trading hubs. Public data suggests that the amount of silver readily available for delivery in certain exchanges is lower than it has been in previous periods. While this can be interpreted in different ways, it is reasonable to say that tighter inventories may increase sensitivity to changes in demand or supply. However, it is equally important to avoid overstating what this means. A reduction in available inventory does not automatically imply that the market is on the verge of running out of metal. In many cases, inventory moves between different locations or ownership categories, and not all changes represent permanent removal from the system. Similarly, when deliveries are reported on exchanges, it does not always mean that physical metal is immediately transported away. Sometimes what changes hands is the ownership claim, while the metal itself remains in storage. This distinction matters because it helps prevent misunderstandings about what the data is actually showing. There have also been claims suggesting that specific large institutions may have reduced bearish positions near recent price lows. While it is true that general positioning data can show trends among different categories of market participants, publicly available information does not identify individual institutions or confirm precise actions taken at exact moments. Any statements that go beyond what the data directly shows should be treated with caution. This does not mean that large participants are inactive. On the contrary, major financial players often adjust positions during periods of volatility. However, it is more accurate to view these adjustments as part of normal market behavior rather than evidence of a single coordinated event. Another layer to consider is the broader economic environment. Global conditions, including energy markets, interest rates, and overall financial stability, can influence commodities in complex ways. For example, rising costs in other parts of the economy can increase pressure on financial systems, which in turn can lead to temporary selling across various asset classes, including precious metals. At the same time, those same conditions can also support the long-term case for tangible assets. This creates a situation where short-term price movements may not fully align with longer-term trends. It is not unusual for markets to move in ways that seem contradictory in the moment. Policy developments also play a role. In recent discussions, silver has been included in conversations about critical materials and supply chain security. While such classifications do not immediately change market prices, they can influence how governments and industries think about resource planning over time. This can gradually shape demand patterns, even if the effects are not immediately visible. In addition, some countries have shown interest in aligning pricing mechanisms more closely with local market conditions. This reflects a broader trend where different regions seek to balance global benchmarks with domestic realities. Over time, this could contribute to a more diverse pricing landscape, although traditional benchmarks still remain highly influential. It is also helpful to consider the difference between a temporary market adjustment and a fundamental shift. A temporary adjustment might involve rapid price changes driven by financial factors, while a fundamental shift would involve lasting changes in supply, demand, or usage. Understanding which of these is occurring can help prevent overreaction. In the current situation, there are signs that both financial mechanics and physical demand are playing roles. This does not produce a simple narrative, but it does provide a more realistic one. Markets are rarely driven by a single factor, especially in times of heightened uncertainty. For viewers who may feel uncertain or concerned, it is worth remembering that volatility is a normal part of many markets. Sudden movements can create strong emotional reactions, but decisions made in moments of stress are not always the most effective ones. Taking a step back and reviewing multiple sources of information can provide a clearer perspective. It is also important to recognize that different participants approach the market with different time horizons. Short-term traders may react quickly to price changes, while longer-term participants may focus more on underlying trends. Both approaches exist within the same market, which can contribute to complex price behavior. When looking at the silver market today, a balanced view would acknowledge that there are areas of tightness in physical supply, continued industrial usage, and evolving policy interest, alongside financial volatility and changing investor sentiment. None of these elements alone defines the entire story, but together they provide a more complete picture. It is also useful to remain cautious about extreme predictions. Statements suggesting immediate and dramatic outcomes in either direction often overlook the many variables involved. Markets can take time to adjust, and outcomes are rarely as simple as they first appear. In practical terms, focusing on a range of indicators rather than a single data point can be more helpful. Price is one indicator, but so are inventory levels, trade flows, policy developments, and broader economic conditions. Looking at these together allows for a more informed understanding. Another key point is the importance of flexibility. Markets evolve, and new information can change the outlook. Staying open to updating one's perspective based on credible data is often more effective than holding rigid views. In situations like this, it can also be helpful to ask a few basic questions. Has the underlying use of the metal changed significantly? Are supply conditions improving or tightening? Are policy or economic conditions shifting in ways that could influence demand? These questions can guide analysis without relying on speculation. It is equally important to distinguish between confidence and certainty. Confidence can come from a careful review of evidence, while certainty often arises from oversimplification. Maintaining a thoughtful approach can help avoid common pitfalls. As the market continues to develop, it will likely provide more information over time. Patterns may become clearer, and some uncertainties may be resolved. Until then, a measured and informed perspective can be more valuable than reacting to every short-term movement. In closing, the recent activity in silver highlights how complex and interconnected financial markets can be. Price movements alone do not always tell the full story. By considering multiple factors, including physical demand, financial structure, and broader economic conditions, it becomes possible to develop a more balanced understanding. There is no need to rely on extreme interpretations to recognize that something meaningful may be happening. At the same time, there is also no need to assume outcomes that are not supported by available evidence. A careful, evidence-based approach remains the most reliable way to navigate uncertain conditions. As always, this discussion is intended for general information and educational purposes. It is not specific financial advice, and each viewer should consider their own situation and seek appropriate guidance if needed.